let's move on to the next topic. DeFi, decentralized finance, which is one of the most fun topics in all of crypto. DeFi summer. All right, so if you enjoyed this live stream, be sure to smash the like button, subscribe, put on alerts, tell a friend to tell a friend. Not being in crypto or being with Token Metrics is a financial crime. All right, so now we're going to do chapter 12 of the book. What is DeFi? So DeFi is this might take a while because we have DeFi, then we have DeFi 2.0. Crypto moves so fast, things change so much. All right, so DeFi 1.0. DeFi stands for decentralized finance, taking services that are done by banks and bring them on the blockchain and having them have no central intermediary. So examples include saving, investing, interests, loans, basically anything the bank does, taking those services, removing the bank, and still having trust. That is DeFi at a high level, right? And this is so powerful because now people that were locked out of finance cannot participate without any gatekeepers. What do I mean by that? All right, so for example, one of the platforms I like and I've used, although the token hasn't done so well due to Ponzi-nomics, or well, not Ponzi-nomics, just poor tokenomics, is Liquidity. So let me pull this up. Where the heck is their site? I'll just look it up on CoinGecko here. Right, because once you get this, you'll get the power of DeFi. Right? What if I told you you could borrow against your crypto and leverage your crypto as collateral to borrow against it? That's an example of a DeFi use case and why DeFi is taking over. And you could do it without asking for permission or doing a loan application. Right? So in this instance, this is Liquidity, right? Interest-free liquidity at your fingertips. You can borrow LUSD against Ethereum at 0% interest rate. And they have over $2.4 billion locked up. Right, so let me log in here. Just give me 1 second. I'm gonna log in using my MetaMask. Okay, so earlier we touched on MetaMask and using DeFi. So this is an example. So right now I'm logging into my MetaMask, which is connected to my ledger, but I'm not going to use my ledger right now. Okay, so by doing this, I'm now accessing Web 3.0, the next internet, right? And this is why it's powerful. The next internet, I own everything that I have, basically. Okay, so in this case, the way this works is, I have Ethereum. I believe Ethereum will flip Bitcoin, and I don't want to sell my Ethereum because I'm losing out on future money, future profits, future gains. But I can borrow against my Ethereum to get liquidity to maybe buy a car, buy a house, pay off bills, loans, what have you, while still having the upside for Ethereum. And guess what? The whole transaction is tax-free because the loans are not taxed, but if you sell, you have to pay capital gains taxes. Because technically, I'm not selling, but not tax advice. Talk to a CPA for that. So with this, so in this example, looks like the UI has changed since I last logged in. I can say that I want to borrow. So typically with a bank, you'd have to go to a bank, put in a loan application. Actually, no, prior to that, you have to be a customer with the bank, typically. You have to open up an account with them. It takes some time, credit check, background check, all that, KYC, AML. Then you basically put an application to borrow money from them. They take their sweet time. So that entire process takes a while. And you have so many people who are locked out of that. Maybe they don't have bank accounts or whatever, right? Okay, can't pass their checks. But with this, with DeFi, you can come here and you can borrow against your money. So in this case, I have Ethereum, and I'm going to borrow against it. Just give me 1 second. Let me just see how this is. Okay, so in this case, I have deposited, this is a loan I did a while back. I deposited 18 Ethereum, which is worth $72,000. And they use a stablecoin, right? A stablecoin basically is a cryptocurrency, a token that is pegged at a stable price, or a stable price range. There's typically a slight deviation, but in this case, most stablecoins are pegged to the US dollar, to the price of a dollar, meaning that one stablecoin, in this case, 1 LUSD, is worth $1 or close to $1. Sometimes it's 99 cents based on fees and transactions, but the most popular stablecoins are Tether, DAI, LUSD is getting pretty popular. But in this case, I deposit my Ethereum into a smart contract. They get the value of this $72,000, and this is all fully automated. And then they let me borrow a ratio of that. Right? So in this case, I put $72,000 worth of Ethereum, 18 ETH, and I borrowed $22,000 in LUSD stablecoin. Just like that. No waiting in line, no opening account. All this was fully automated with software, with code, with a smart contract, right? And the reason why this is powerful is there's no interest rate as well on this. So people are wondering, how do they do this? How do they manage this, right? They do this using essentially math and collateral, right? So in this case, you have what's called my collateral ratio. Sorry, this is the ratio for the whole network. So for every dollar borrowed, they have 226% collateral to cover that. Yeah, and in my case, I borrowed $22,000 and they have $72,000. So they have 225% ratio. So that if the price of Ethereum fluctuates, as long as I still have enough money to cover my debt, I am good, right? Now, what happens if the price of Ethereum crashes? Because it happens in crypto, right? Let's say ETH tanks 40% due to a black swan event, like with the pandemic. So let's say ETH goes to two grand. Let me actually go over here. If we go to liquidation, right? So the way Liquidity works as a platform is they go through and you have to maintain a ratio of 110% or more, right? So if you borrow $100,000 worth of stablecoins with ETH as collateral, with Ethereum as collateral, you have to put $110,000 minimum. If your ratio drops below 110%, it gets liquidated. Basically, your collateral is sold to cover your debt. So you have to basically manage this game of making sure your collateral is worth more than the collateral ratio of 110%. Now, it may get somewhat technical, but it's still pretty simple at a high level, right? You have to maintain above the collateral ratio. Now, let's say the whole network as a whole goes through this essential digital bank run, right? Where everybody's trying to withdraw money because of the crash. There's a fight to liquidity. What do, right? So, I'm not sure if they covered this here. Okay, that's not what I wanted. But when that happens, they shift the ratio to 150%. And when that happens, basically when there's a bank run based on a market crash, everybody has to maintain 150% or more. And those who have lower than that get liquidated by other people. I can log in here, I can liquidate that, and in exchange for that, for taking initiative to liquidate somebody, it's kind of cutthroat in that manner, I get a chance to purchase, I believe, Ethereum at a discount. So basically, it's a convenience fee, right? Now, this all seems fine and dandy, but without getting too deep into this, I want you to understand the power of this, right? Because my ratio, I'm pretty good, right? I'm not gonna get liquidated anytime soon, but I was able to borrow money on Ethereum, on this platform, what I do with that money? I take that stable coin, I then take it to an exchange, which is also part of DeFi, like 1inch exchange. Because my goal is, how do I convert LUSD stablecoin to actual cash in my bank account? How do I do that? All right, so the exchanges that I use are Gemini and Coinbase Pro. Not Coinbase. Coinbase Pro is better because they charge you lower fees. Coinbase regular is good in the sense that it has a better UI, UX. It's basically a better experience for users. It's newbie friendly, a lot easier to use and simple to use. But in exchange for that newbie fee, for being a newbie, they charge you a lot more in fees. So you can't use Coinbase, but most pros use Coinbase Pro because they're lower fees. But anyway, how do I actually cash out? So I would go to a platform like this, like CoinGecko, and say, okay, where can I cash out LUSD, which is the stablecoin they gave me on Liquidity, right? Then I come down here to markets. You can also do this on Token Metrics, right? So I'm looking for a Fiat Gateway. What does that mean? Fiat Gateways are where you can connect your bank account and wire dollars or whatever currency you have in your region, the euro, the yen, and you use that to cash out, right? So Fiat Gateways are the gateway where you bring your dollars, you buy crypto, and you convert vice versa. So in this case, I want to take crypto, convert it to dollars, and cash out to my bank account. It could be Bank of America, Chase, whatever bank account you have. So in this instance, all these are different markets where we can trade, but I want a Fiat Gateway. I want the US dollar. So guess what? There aren't really any Fiat Gateways for this. So this becomes a challenge now, right? Where do I go? There's no gateway. I mean, there's no Coinbase, there's no Binance or whatever. So what you can do is you can swap LUSD to a different asset and use that to cash out, right? So in my case, I like Coinbase Pro for depositing dollars to buy crypto. But cashing out, I prefer Gemini because Gemini has no withdrawal limits. With Gemini, if you have a large portfolio amount, you can withdraw $500,000 or more, just like that, in one day, without any questions asked. On Coinbase Pro, you typically have to go through and request permission to increase your withdrawal limit. So I don't like having to ask for permission to withdraw my money. So I come here to Gemini. Actually, sorry, not Gemini dollar. Gemini the exchange. Then I look at the markets they have, right? So what stablecoin do they have? Stablecoin they have is DAI USD. As you see here, $1 gives you 1.999 DAI. So how do I convert DAI? How do I convert LUSD to DAI? You do that through a decentralized exchange. You can do it through Uniswap, you can do it through 1inch exchange, or you can do it through Curve, right? So Uniswap is the most popular one, and so is SushiSwap as well. But I like 1inch exchange because it's called a DEX aggregator. It takes all the different DEXs out there and finds the best prices for you automatically, so you don't have to, right? So in this case, let's say I wanted to convert the LUSD I borrowed, right, to DAI. I don't have any now, but in this example, let's say I had, what, $72,000 worth. Where would I get the best slippage, right? So in this case, 1inch would give me the most money. Slippage would be minus 0.19% versus Uniswap, which is minus 0.26%. Right? Now, a better exchange for converting just stablecoins, because 1inch exchange is good for any crypto asset on the Ethereum blockchain. And its assets on the Ethereum blockchain are called ERC20 tokens. So one that's best for stablecoins is called Curve, because it's designed with what's called a bonding curve, because all these are automated, right? It's what's called an automated market maker. It's basically an exchange where you're trading against two different pools of liquidity, right? Two different trading pairs. In this case, we have DAI and we have USDC. Now this gets somewhat technical. I don't want to get too technical because it's meant to be a high-level overview or masterclass on crypto investing. But when you have two different trading pools, basically using math, using an algorithm, they balance each other out, and they use that to find the best price to fill. It's called a bonding curve. So if you just search crypto bonding curve, let's find the actual image here. This is how the price is balanced, right? So basically you have the pool balance and the token supply, and using algorithms, it's basically calculating what price based on how many tokens you have, right? So let's say you add $100,000 worth of Ethereum. I'm sorry, yeah, $100,000 worth of Ethereum and $100,000 worth of DAI in the pool. It's basically trading against each other to create an automated exchange. And as people go through and buy and sell, there'll be an imbalance. That imbalance creates basically the bonding curve. But anyway, for stablecoins, because most assets are pegged to the similar price, a dollar, having a bonding curve for non-stablecoins is not ideal. It's better to have one just for stablecoins, which gets you a better price, right? So in this case, we want LUSD. Right, so we take that LUSD there. And if we're going to Coinbase, we can use USDC, which is the Coinbase stablecoin. It's regulated. But I want DAI because I went to Gemini. And I'll put in the same price. I'll put in $72,000. So on Curve, $72,000 worth of LUSD gets me $71,937.23. If we come to 1 inch, right, 937.23. Yeah, so if anything, I think 1 inch here is actually going through Curve. So that's why, I mean, if you're doing stablecoins, it's best to use this, but just doing purely on 1 inch, they typically can find the best platforms for you, right? So you basically convert by selling your token from LUSD to DAI, then you transfer that using your wallet to your exchange, Gemini, and you cash out, right? So that's one way to borrow in DeFi without any middleman, no bank, anybody asking for permission or gatekeeping, right? Then the other element of DeFi that really helped DeFi just grow is yield farming. What is yield farming? Think of having a bank account where you're earning an interest rate on having money in your bank account, right? Your savings account, except you're not really earning much to keep up with inflation, because inflation was pretty high, and so is the decline in purchasing power. But when it comes to crypto assets and DeFi, these are networks, right? These are protocols that are taking services done by banks and they're trying to disrupt them. But they need liquidity. How do you bootstrap liquidity? How do you incentivize people to add liquidity on these protocols? Because, for example, with a DEX, a decentralized exchange, like Uniswap, OneInch Exchange, and others, you have to have trading pairs to trade against. And there has to be liquidity for you to trade against that's automated. And that needs people's money in there. And people won't just give you money just to trade for no reason unless there's any upside for them. Right? So you have to give them a reason to put the capital up into that liquidity pool, also called an LP pool, right? Basically, these people are called liquidity providers. And by adding this liquidity, they expect to earn some kind of incentive, some kind of reward, some kind of interest on this. And this is where the term yield farming comes, right? Yield farming basically means that you're adding your liquidity to a liquidity pool, and in exchange for that, you're earning a yield on that. You're yield farming, right? And the incentives on this can be pretty high, right? So if we go to, for example, Curve, right? These are the Curve pools, right? For anybody who adds liquidity here, actually Curve is probably not the best to use. Curve liquidity pools are pretty low. But let's go to Zapper. If we go to pools here, we can see the, okay, this is not what I wanted. Let me just see which, actually CoinGecko has this as well. All right, so if we go to DeFi, Looks like they moved this around. Okay, give me something. Okay, yes. So actually, CoinMarketCap has the rates on this. So for instance, if we go to highest APYs, right? So in this case, PancakeSwap, which is a DEX on the Binance Smart Chain. Basically, this is Binance's blockchain, and their DEX is called PancakeSwap. Their decentralized exchange is called PancakeSwap. But the liquidity is very low, right? Liquidity is only under $4,000, right? And the APY here is high, but it's not ideal, right? Ideally, you want to put assets to work into a liquidity pool that's liquid. Otherwise, you face liquidity risk and then impermanent loss, which is not good. All right, so for instance, sorry, my iPad's about to die. Okay, there we go. Okay, so let me see which one I am doing. Yeah, I'll actually use Armor Finance as an example, even though I'm not using this anymore. But if you go here to Liquidity Rewards, right? Basically, if you have Armor and Ethereum, and you add it to the Uniswap liquidity pool, this is their pool contract address, right? So basically, the way this works is you take your Armor tokens that you already have and your Ethereum that you already have, and you stake it in a Uniswap liquidity pool, all right? So you come here. I have to connect my wallet. Let me connect MetaMask. Okay, so here I've connected this to MetaMask. Okay, so you come here, you go to add liquidity. Once you do that, right? I don't have any tokens, but you would come here, and by doing this, by adding my Armor tokens and my ETH tokens, I pick the share, but they have to be an equal balance. So let's say I added 10 ETH, then I have to add 10 ETH worth of Armor. Actually, let's do it with 1 ETH. And out of the entire pool, my total USD value combined would equal 0.57% of the pool, right? Then they gave me a new token called an LP token, liquidity pool token, right? That represents my ownership share in this liquidity pool. Then basically my assets are locked in this pool. And then I take those tokens that represent my ownership share. I come back here. I then stake them to lock them up as well so they can be moved. And by doing that, I have locked up my liquidity and my ownership share in that. And now I'm earning yield on this. So this yield will be 103% APY. So basically, in 1 year, if I have $10,000 worth of Armor and ETH, I'll be earning another $10,000 plus in Armor tokens. Right? This is where it kind of becomes risky, right? Because if you're bullish on the asset you're yield farming, that's great. If you aren't bullish on it, if Armor tanks like it did, then guess what? Your tokens become worthless, right? It's supposed to be worth $10,000. It could be worth $2,000 or nothing, right? So it's a gamble, right? Okay, so yeah, this project is kind of pretty much dead, but it's a good example of explaining yield farming, right? Then there are platforms out there that automate yield farming for you, right? Like there's Harvest Finance, for example. Right, so Harvest Finance takes that concept of yield farming and automates this across different pools. So it's almost like a robo-advisor for yield farming. And now this has been hacked several times, so which happens in crypto and DeFi. So before you engage in anything, make sure that it's been audited. This is something I didn't cover too much in the technology part, But any project in DeFi, you want to make sure there's been a code audit by a reputable company that's public that goes through and sees if there are any possible hacks or issues that can be hacked. Right. So in this case, Harvest Finance, which we've covered, is scored over an 80%. You can come here and it can basically manage your pools for you. You can pick what pools to invest in, right? But this is kind of getting advanced. I want to keep this high level, but this is basically automated yield farming across different tokens and protocols. And looks like they just added one for Polygon, which is pretty cool. Right, but that's essentially is yield farming at a high level. Let me see what else I want to cover for DeFi. We covered DeFi lending and borrowing, yield aggregators, derivatives. Yeah, I think that's basically it. That's DeFi without getting too deep.